Coming to you live from downtown Detroit, this is Benzinga's PreMarket Prep with your host, Joel Elconin.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I will buy the stock for a penny.
With everything you need to start your trading day.
Joel, I don't see a stream.
What do you mean? I see it on the thing.
And I take that back because I do see it. And welcome everyone to this Friday edition of Benzinga's PreMarket Prep. Spencer Israel here with Joel Elconin and Dennis Dick. Got a jam-packed show for you today. Phil Davis will stop by at 8:35. But before that and after that, we have earnings to discuss, and we're going to have a quick discussion about imbalances and sort of why we use them. Joel, what's doing in the markets this morning?
S&P futures are looking good as always, up 575, 25.67 and a quarter. I'll give you that pre-market high, 69 and a quarter. We're still a ways away from our all-time closing high at 25.74, and our all-time high was made on Monday at 77 and a quarter. Crude still in its trading range, down 19 cents at 52.45. Gold continues to melt down 210 at 1267.50, and silver down 16 cents at 1666. Dennis, I'm going to bring you in here, and wow, have you ever seen three of the big guns with such big beats and big upticks, big rally in the market today?
Blowing it away. And we're talking Amazon, and we're talking Google, and we're talking Microsoft, all of them blowing the numbers away, all of them rallying significantly here in the pre-market and significantly last night. You know what I was thinking last night when I looked at the S&P futures, trading up about 5 points? I'm like, man, that S&P future is up 5 points. It's all Google, Amazon, and Microsoft. So that means the rest of the market's flat. So, one of two things are going to happen. The S&P future is going to have to go up further to make up if this is going to drive the whole market higher, or there's going to have to be money coming out of some other sectors. Well, we're seeing a little bit of both because the S&P futures have rallied another 5 points, but we're also seeing money fly out of another sector. Do you know what sector that is today, Joel?
What do we see?
Come on, and you can blame the dog of all dogs for it.
J.C. Penney?
Yeah, the money is going to come out of the retailers, it looks like, here today, and you can blame J.C. Penney. J.C. Penney down a quiet 23%. Nobody's even giving them any love for their disastrous warning here, which we're going to get to in a second. But it's knocking down. Your Macy's is down 6%. Your Kohl's is down 3%. Your JWN's trading down here in the pre-market. It's going to be an ugly day for the department stores, thanks to J.C. Penney. So we've given you lots of stocks here. Where do you want to start?
Well, first, I want to know how in the heck you let the S&Ps get down to 57.50 at 11 o'clock last night. I mean, because
that means nothing to me. 57. I don't. That's like you talking in Chinese to me.
Chinese.
Because I don't have S&P futures quotes because I don't want to pay $600 a month. Yes, when you're licensed as a pro, they want to charge you $600 a month for S&P quotes. I'm always going to give this rant about once a week on it, CME, and I said no. I'm just not going to get quotes at all. I used to pay $75 a month. That was okay. $600 a month, forget about it. So now I just get the SPY quotes. So I see SPY, but it doesn't trade 11 p.m. So I can't tell you what it was doing. So what would the SPY equivalent be?
We will scratch that from.
What was the SPY equivalent there of the fall? Was that
well?
Flat?
The SPY wasn't open because no one cares to trade
well, you
it
can
at
always
that time. It's a worthless vehicle. It's not.
Come on, no, it's not a worthless vehicle. Well, obviously it's worth a little bit less because I don't pay $600 a month for it. But anyways, okay, so we're going to go into a fight here already at 8:06 in the morning. But okay, so when you were saying it was at 57, was that flat on the day? It was
down on the day. It was
down.
Yeah.
Well, that's insane.
Yeah, that was my point. But
I should have been up there buying S&P futures, even though I don't have quotes on them.
Exactly. I should have alerted you, and you should have done some kind of secret trade for exchange for physical or something in the spiders. But I'll just give you. We'll go to J.C. Penney. I don't know how many people are active in this thing. Pre-market low 260. Got a seller at 280 now. I believe this is like
Seller at 280, close at 366. Every institution is selling this stock here. I mean, this is. Go ahead.
That's it. I mean, support. Should we play Dennis's thing where he says, "I will buy this stock for a penny"?
I you know what?
You won't.
I won't buy. I might not buy JCPenney for a penny because I'd lose a penny. I think it's going to zero. I've said that for a while, but it's the longest road to zero ever. Because you look at this thing, it's felt like it's been going to zero for 5 years now. In 2014, we got down and kissed under $5 for the first time at $4.90. Then we rallied up to $10. Then we came back down at the end of 2014, got down to $5.90. Then we rallied up to $10. Then we came down 2015, got down to $6. Then we rallied up to $11.99. So really getting people excited. Then it came down to $7. Then it got over 10 again. Then you know what? I'm going to go out on a limb and say this stock is never going to see $10 again. I'm going to say it here now. It saw it. It saw it after, had the nice rally in 2014 from 5 to 10, 15 from 6 to 10, and 16 from 6 to 10. In 17 we got down to $7, and then we got back up over 10. Now at $2.76, I don't think JCPenney ever sees $10 again.
Okay, we got probably the question of the year here from buy_Apple. Would you rather buy JCPenney or dry ships?
You know what? This is a tough one. In my long-term investment account, I don't know. You know what? Maybe dry ships because there's actually some upside still potential with dry ships. I don't know about JCPenney. I mean, sure, can the thing go up to $3 or $3.50? Maybe, but give us the numbers here, Spencer. Here we are talking technicals, and we left Spencer right off the show. He's over in the background. He's got a tear in his eye because they're forgetting about me in the background. Give me the numbers here, Spencer, on JCPenney.
Do we even need the numbers?
We need these numbers because they're good. They're juicy. Give me these numbers.
All right. Here's what they see their Q3 EPS as: 40 to 45 cent loss versus an 18-cent loss estimate. They see comps as down about 3/4 of a percent. Their fiscal year adjusted EPS in total for the fiscal year, it'll be 2 to 8 cents. 2 to 8 cents.
They're going to make 2 cents?
Or 8 cents.
Well, they just lost 48 cents. How's that math add up? I think they're going to miss those 2 to 8 cent estimates when they're starting at minus 45 in the hole.
For the fiscal year,
include the minus 45 cents that they're going to post here this quarter?
That's what they said for the fiscal year. Okay, yes.
Optimistic over at JCPenney where the tumbleweeds are blowing through the stores there. No, I think they're going to miss those estimates too. I don't think this company is going to make money maybe ever again. That's what I'm saying anyway. So, do what you want to do with that information, but this is, $2.80 here now. Joel cited the big seller. He's right. There is an iceberg there. Just traded like 50,000 shares at 280 and he didn't budge. That's some institutions have been holding it forever, and they're like, we're out. We're going to sell 10 million shares here.
All right. You see Kohl's trading low at the low of the pre-market session, 42.50. Macy's trading down at 20.05. They're all getting hit. Target getting hit. Let's see how Target.
Target will hold on a little more than the other one. Because they sell other stuff and they're like a Walmart. Target, Walmart are kind of their own animals. They'll probably take a little bit of heat for this, but they're not going to take nearly the heat that Macy's is taking, which Macy's is trying to get under $20 here again. Kohl's down 2 points. They're hitting Kohl's on this. Wow. And I like Kohl's the best. If I had to own one of them, I've said before, I would be Kohl's. Now, I don't own any of them, and I don't know if I want to own any of these department stores, but if I had to own one, that'd be cool.
Take a look at
JWN's holding on too. It's not down much, but it's very widespread. So, and it's offered up for 41.85, and nobody's lifting that. So, I would imagine you're going to see at least a point come off at JWN. And don't forget about Dillard's over there, DDS. That's held on okay. Dillard's is still over $50. Lots of meat on that bone.
All right, the Kohl's, I was just looking at the $42 level. We haven't got that yet. You had a couple lows under 42. We'll see. That could be a potential stopping point. You actually have an exact low. Oh, that's quite a bit under 41.57. You have another low at 41.32, 41.40, 41.50 area. What just happened to Merck? I mean, did they say something on that conference call? Or
they were trading up, and you know what? They're a drug stock. Right now, this is not the quarter to be a drug stock in. It does not matter, it seems like, what you say. And AbbVie's trading up right now. I'm almost tempted. I am long AbbVie. I'm almost tempted to sell just because it's the only one that's been trading higher, but I'm not going to do that. I'm not going to start trading my investment portfolio there.
That'd be fun.
But But almost thinking, like, wow, here's AbbVie trading up $2.44. Is there any drug stock that reported earnings that actually closed up on the day? Biogen got destroyed on their earnings report. Celgene destroyed on their earnings report. I know AMZN tried to come back actually yesterday from its earnings report, and somebody had a good call in the chat saying they were buying the dip on AMZN, and it came back. But you look at all these drug stocks. Even Abbott Labs was up significantly on its report. I believe it closed red on the day as well. You've just had a disaster in all these drug stocks, and no disaster bigger than Celgene, obviously.
Bristol Myers as well as another stock.
Yeah, Bristol Myers, BMY also joining the party. And if you want to just look, what else? Somebody else reported last night. Gilead. Gilead was trading up on their report for about a minute, and now it's back at 75. I guess that was a good sell on Gilead.
That was. I've been thinking about that.
The problem is, you know what the biggest problem is? I took the Gilead money and put it in Allergan. So I'm still getting whacked. And I'm down probably the equivalent of what Gilead fell to 10 points when you do the math on that. I actually might be down more on the Allergan. So I shouldn't have moved it into a different drug stock. I should have just moved it out of drugs altogether. Hindsight's 2020.
All right, man. Do you want to do the Merck report? Do you want to do, I see ExxonMobil just came out with a beat. Where do you want to go, Dennis?
I don't know. There's so many places to go. Do the Merck real quick, Spencer. Give us the news on the drugs here. Merck, obviously disappointing somewhere there, although the quarter looked okay to me.
No, I don't know where they. You tell me where they disappointed. Q3
it doesn't matter. You're a drug stock. You can't report earnings if you're a drug stock right now.
$1.11 versus $1.03. Sales of 10.3. Okay, so here's where there was a miss. 10.3 billion versus 10.55 billion dollar estimate. So slight miss on the sales number for Q3, but they're raising their fiscal year EPS and sales guidance.
On a normal day, the stock would be up. This is not normal markets for drug stocks. They are absolutely hated right now. So that's all about. It's all about understanding the sectors you're trading. It's not about the individual reports, because the overall sentiment towards the sector drives price more than anything right now. And right now, drugs are absolutely hated. They are hated. It doesn't matter what you're reporting right now. If you're a drug stock, they will try to find a reason to sell you. Except what's the AbbVie report? Because AbbVie, they must have really blown it away, because it is actually trying to go higher, and it's a drug stock. And it's a biotech drug stock.
We are all over the map.
We're waiting. We're waiting for the AbbVie numbers. Spencer. Alpha Victor.
I got you, AbbVie. I was looking at Twitter. Sorry, I got distracted. AbbVie.
What was yesterday's news, Spencer?
Well, I was looking at actual Twitter, not the stock. $1.41 versus $1.38. 3-cent beat. Sales of 6.99 billion versus $7 billion estimate. So they slightly missed that. Fiscal year adjusted EPS guidance coming in line, but like on the low end of that estimate. $5.53 was the estimate, and they in line with $5.33 to $5.55. So mostly.
Really?
Fiscal year adjusted EPS guidance for 18. Excuse me, fiscal year 18 EPS guidance coming in line as well.
Okay, well, none of that sounds that great to me, so I don't know if they said something else. Maybe they're just feeling sorry for me in my investment portfolio, because all the other drug stocks I had got absolutely murdered. I own Biogen, I own Celgene, I own a lot of drug stocks. I own Merck. I don't own Bristol Myers. I do own Allergan, which has been killed, and I own AbbVie. So maybe the market's feeling sorry for me right now and saying, look, we're sorry about the 20% we knocked your price down on Celgene there, yesterday, basically. We're sorry about the 10% we knocked you off in Biogen. So here's 2.5% for AbbVie for you, Dennis.
Dennis, pull up your investment portfolio right now.
What do you want me to do?
Pull up your investment portfolio. And
sell AbbVie.
Sell AbbVie at 92, okay? Because I don't want to hear on Monday when this thing is at $85. I don't want to hear you complain.
It was $85 yesterday. Did you see the movement yesterday off of Celgene? It didn't even say anything yesterday, and it got down to $85.24. They hit every biotech off that Celgene numbers yesterday. They absolutely it opened. And it just absolutely died. That opening bar, it opened at 91.70, and 5 minutes later it was $85. It basically crashed. It had a little flash crash down $7 in like seconds off the open.
Let's see if I can get
this crazy candle right there.
Let's see if
crazy candles here.
It actually took 2 minutes, Dennis. You're exaggerating.
It felt like 5 seconds to me. So I was looking and gagging as I'm looking. Look, my company AbbVie, I'm down 10% in my AbbVie investment. I didn't even do anything. They didn't even say anything. It's just because they're drug stocks. So, okay. So maybe everybody washed out there. Maybe everybody's, 92. It's back here right now. It kind of makes me want to sell it, but I'm trying to stick with all these stocks long term. I actually bought more Celgene yesterday too, Joel. I couldn't resist. I had to come in. I nibbled and bought a little bit more Celgene yesterday. You know what's really gagging? Because my average cost was on Celgene was $27. I raised it to 52 yesterday. I was like, ooh. That doesn't look nearly as nice, because when it was 27, it was up like 300%. Now I'm only up like 98%. That really hurt on the percentage basis.
It's interesting that made a 94.55 low, and I don't know how many times you can go back and look when you have these big news events, right? And there's exaggerated moves. Man, a lot of times that could be the high or the low, for a long time, and the street overreacts. It's going to take a while to get back down to that 94.55 low, right? People thinking they missed the bottom. Close at 99.99. Let's see what we're doing in the pre-market. It's just pre-market high 102, so I would keep an eye on that. And then if we back and filled 94.55. AbbVie, the thing that's a little bit, Dennis, overhead supply in the AbbVie. You came off hard. You talked about the price action from yesterday. You got to pop to 94. Your 3-day high is 94.14. We're a couple bucks away from that, so keep an eye. Is that an important level? So scary to
buy a drug
stock,
right?
And Dennis, you just hopped around there. I don't even know what chart to pull up next.
Okay, let's go to the big guns here. Everybody's talking. We'll go to what everybody else is talking about here. They're all talking Amazon. They're all talking Google. They're all talking Microsoft. The only one I own in my investment portfolio of these ones is Google. So let's start with that one there, because this is directly impacting me. I've got the GOOG. It's up 40 points here. I like that. I like Google. I said it yesterday. I like it long term. I still like it long term. I like it even more long term as it's making new all-time highs.
$9.57 versus an $8.33 estimate. Sales of $27.77 billion versus $27.2 billion. So a beat on both the EPS and the sales number for Q3.
The stock is a monster, Joel. When you really look at this has been one of the best stocks I've had in my investment portfolio. I bought it. Oh, man. I've had this one for quite a few years now. I had it well before the split. I think I bought this around 2012. So really, when you look at that, and I did sell half my position, so I shouldn't say, I have the whole position anymore. It got up, and when they did that, they gave me both stocks on the split. I was like, I don't need two Googles in my portfolio. So I sold the GOOGL, and I kept the Goog. I guess I kept the wrong one, but I think at the time, the one I sold was worth more money still. So that premium is still there.
Looking at this, I'll just give you the pre-market high in these. They're $1,000 stocks. They're going to whip all over the place. You get initial pop 10-20, and then you came back down to the $1,000 levels. So, and just nice 15-minute chart, just nice steady move up. Keep an eye on that pre-market high. That's for the Goog. For the GOOGL, your pre-market high comes in at 1040. Had a pullback just under 1020. Looks like that pullback was to 1017.62. So those are your early parameters for GOOGL.
Let's go to Amazon. Amazing. The stock is amazing. See what I did there?
Yeah, we got it, Dennis.
It's up 79 points, Spencer. Oh. 79 points. What did they say? Did they say they're like taking over, or they're just going to be everything? What did they say?
Q3 EPS of 52 cents, which is the same as it was in the same quarter last year. Sales of $43.7 billion versus a $42 billion estimate. They see their Q4 sales coming in at $56 to $60 billion, which is just in line with the estimate, and operating income at between $300 million to $1.65 billion. They also said on the conference call that they expect to increase their video content expenses next year, which we all know is a hot space to be in right now. So more Amazon videos.
Nothing sounds that great to me, but you want to know something? When you look at the Amazon chart coming in, what was the stock in the last 3 months?
In the gutter.
It was a laggard.
Yep.
And what have we been saying? The stocks that have been laggards coming into the earnings reports have actually been popping. It's funny to say that Amazon has been a laggard, but it got up to about 1080 in July. It's just been meandering down here under $1,000, and boom, they report an okay quarter, and she goes berserk. And that's what all these stocks really did. I mean, Google's the same thing. It's kind of been meandering here for a little while. We haven't really, getting up there. I mean, it's closer to the highs than Amazon was, but it even applies to FANG, it looks like. And, normally we're saying how strong these stocks are going to earnings, but Amazon was not strong going to earnings, and it was good enough this quarter.
And your former 1083. So we got a little ways to go to get to that all-time high. 1055 is your pre-market high. You had to pull back to 1040, but I mean, it's just not giving in here. Look at this. I mean, after a 78.5 point move. You still got bidders here, 4 points from the high. So I don't know, 1083.31. I mean, if you want to really get out of the stock today and you think it's making an all-time high, maybe you can get in there at 1083. But I mean, I can't say that you see any weakness in this thing. Maybe if
no, it's not even trying to leak.
Look at that, 1040.
People are like, whoa, we forgot about Amazon. We better put this back in our investment portfolio. For 3 months, we haven't been buying Amazon, and all of a sudden, they're pretty good quarter. Let's buy them. That's what happens.
Yep, there it is.
And the department store debacle on the other side is probably helping Amazon too, because they're not spending any money at department stores, especially JCPenney, so they must be spending it all on Amazon.
All right, let's go. Do you want to go to
do the other big gun?
The other big gun,
Microsoft.
Mr. Softy.
Yeah.
$4.
$4.
$5.
It's $5 now. $5.
That's ridiculous.
$5. Wow.
Well, Spencer.
84 cents versus 72 cent estimate. Sales of 24.5 versus 23.6 billion dollars. This is for the Microsoft first quarter is what they were reporting for. This is their Q1.
This is just breakout central over the 80, over the 81, over the 82, over the 83, now over the 84. Where it stops, nobody knows. I don't know, $85? What's the pre-market high?
Well, let me wait a second. It's at 84.10, but let's just wait.
It just keeps climbing. It's the slow, steady climb in Mr. Softy. And man, this is another one that I'm kicking myself on. Back when this got down into the 20s, back in 2011, 2012, and I bought a lot of stocks back in 2012, and they were all good buys. I mean, it's just we've had such a relentless bull market since then. I remember looking at Microsoft at $27 and saying, it was back then it was like an Xbox company. Like it was all about Xbox. That was like their gun. But I'm like, they got a lot of their stuff cooking there too. I actually even talked to my one buddy, Capel there, and he listens to the show sometimes out there at the University of New York. If you're listening, Capel, hello. I remember saying to you, I was like, you know what I really like right now is Microsoft. I think that's be a real good buy. I bought shares. Do you remember this, Joel? I bought shares in my investment portfolio at 27. And for whatever reason, I don't know why, I changed my mind, and I ended up selling it at like 29 or $30. That was an absolutely terrible sale, because here we are 5 years later, and this is why you should not trade your investing portfolio. Because looking back on that now, I was like, why did I sell those Microsoft shares that I loved so much at $28 when it's now at $78 or $84?
$84.10.
That's why, folks, you don't trade your investment portfolios. You buy your stocks and you forget about them, and you're happy that you did it. That's how you get these big gainers. I screwed up that Microsoft by trading my investment portfolio. Cardinal sin. 84.10,
83.94 last print. Will 84 be the whole number that will finally put a little dent in this thing? Up 5.17. Biggest move I think I've ever seen in Microsoft from a dollar point and a percentage point basis. So trade 500,000 shares. I'm not sure what traded last night. Let's see what happens at $84 off the open.
All right. Million other reports here. Should we go to big oil?
Big oil.
Exxon. I don't know if we've heard Chevron yet. Chevron's been quiet here, but we definitely heard Exxon. What Exxon have to say?
We have not heard from Chevron yet, to answer your question.
8:30. I remember. Yes, I've got the memory on this one. They're usually always at 8:30.
Yes.
So 4 minutes. Spencer will break in with breaking news on the Chevron.
And Exxon is I think always at 8, and it came out at 8 today. 93 cents versus an 86-cent estimate for their Q3 EPS. They said they reduced that by 4 cents due to Hurricane Harvey.
Well, ExxonMobil trading up above 50 cents here. I don't know what to say on ExxonMobil. This is one, obviously, I had in my invest portfolio for a long time. I sold it up at 90 just because I thought it got down too far. I was hoping it would get that back down to 70 where I originally bought it. It did not. $76 is where it got down to, so it almost got there, got halfway there. $83 is back here now, 84 bucks, 3.67% dividend. I don't know long term if I'm interested in this one or not. Short term, Joel, I'll give you some levels up.
All right, spiked up to 85.11, but you got a real slow leak going on, and I don't like that when the stock is a buck off its high. ExxonMobil, let's take a look. You had sellers congregating just under $84. Your last four highs with it at that 83.75 level. The close from yesterday, 83.47. So I would let it leak here a little bit to the close, but if it went red on the day, I think you can easily take out the double bottom at the $83 area. Don't like it that it's a buck off its high.
Waiting on Chevron. A couple other stocks, though, that reported last night, which absolutely got murdered. So it's not all good news here. If you're an Expedia, holy cow, this is a disaster of the day, maybe. EXP's already traded 55,000 shares more. Traded a ton of stock last night. It's down 24 points. What did they say?
Q3 adjusted EPS of $2.51 versus a $2.62 estimate. Sales of 2.966 versus 2.98. So slight miss on the sales, a bigger miss on the EPS, though.
Did they say anything about guidance?
I've not seen it.
I'm wondering if they did, because the thing was around 135 and then I had a whoosh about an hour later down to the 125 area. So I'm wondering if they said something on the conference call. Anyways, it's down 24 points. The market has spoken and has spoken against Expedia. If you want to look at sympathy plays, Priceline obviously comes to mind. It's down 27 points in sympathy, which isn't that bad, really. It's only down 1.4%. It's a $1,900 stock. And then TripAdvisor, TRIP, is trading down 3.26%, but nothing like the 16% that Expedia is getting hit on.
And boy, oh boy, 122.51. That's your pre-market low. But you know what? You're only trading 20 cents above that. So that is not a good sign at all. We'll see what the low is right before the open. Got a number for you, 118. Two monthly lows back earlier in the year at 17.95 at 18.34. So another $4 maybe downside there. Always a better place to cover a short than to try long in this thing. And I think they're hitting Priceline on this too, aren't they, Dennis?
Oh, yeah, Priceline and Trip.
Wow. Priceline, $1,800.
It's not, but I was saying Priceline isn't down that much, really, when you think about it. $27. Oh no, sorry. It says 20. It's actually at 18.95 here right now. Well, it's 25-point spread, so 25-point spread. It's down $27 with a 25-point spread. But the last tick, actually, the full last tick is which isn't an odd lot because Priceline trades all in odd lots, and for whatever reason, my system doesn't change the price when it's an odd lot trade. Is 11.80. It's offered at 10, so it's gonna be down probably $50. Yeah. But really, it's only like 2%. It's not that bad.
All right, so let's take a look at a disastrous report here in Mattel.
Oh, the toy maker. Oh, and they're blaming Toys R Us, but really what's to blame is Mattel.
Mattel, Q3 adjusted EPS of 9 cents for Q3 versus a 59-cent estimate. Sales of 1.56 versus 1.82 $1 billion. It was halted yesterday after the bell. After this report, they're also suspending their dividend.
Suspending it. So if you were in Mattel for that juicy 4.65% dividend, it is no more. They are suspending it, and I'm going to go out on a limb and say that they may never bring back a dividend in Mattel. This stock is not. It's $45 in 2013. Now $13. I mean, the only good news, I guess, it's off the after hours lows there, Joel, but it's really no good news if you're Mattel.
And if you want to buy this back at the same level it was in March of 2009, you can look for 1036. The following month, it was a low of 1127, right? So that there's a couple lows. 1110's your pre-market low, and you're getting a springboard off that near up over $13. So look for back and fill in here. In fact, I would have to guess that if it got anywhere near $12 on a decline, I think you're going to find buyers there. You had a triple bottom base the 15-minute chart there, so you might have missed the low. And Dennis, should we make a long-term call here in Hasbro? I mean, they do. I know you're a big Star Wars fan and everything, but man,
new movie's coming.
what do you think? I mean, can they decouple from Mattel from this? I mean,
they have, and they've done everything right, and they continue to do everything right. This is what I'm scared of. Point Joe C is making, that tech is the new toys. He's saying kids want iPhones, iPads now. They are. I've got a 3-year-old at home, and he knows how to work that iPad. We have a little iPad. It's got like YouTube Kids app on it, and he watches, these little videos, even like, jumping on the bed, like the old nursery rhyme songs and stuff. And he loves it, and he could work that thing a year ago. He could work that at 2 years old. So they work these, and I think it's good to introduce some technology to your children. That's what he prefers. I mean, out of all of his toys, and he has a ton of toys, and we try to limit the screen time obviously as much as he can, because it's not that great to just have your kid on the iPad.
You set a great example.
That's what if it was up to him. If it was up to him, he'd be on that iPad 24 hours a day. The kids like the technology toys. And that is not good news for Mattel and Hasbro, which are making your traditional toys. I mean, Hasbro's figured out the stock has held on well, but I don't want to own a toy maker just for that reason.
No more monkeys jumping on the bed?
That's one of his favorite ones. He's sitting there watching the monkeys jump on the bed, bumping their head. The doctor said.
All right. I'm bringing us back here. I'm bringing us back to Chevron because they came out 2 minutes ago. Q3 EPS of $1.03 versus a 98 cent estimate. Sales of 36.2 versus $34 billion. So a beat on these sales and a 5-cent beat on the EPS.
Not good enough. You know why? Chevron has outperformed all these other oil stocks. I don't know what Chevron's been on, but it's been on crack, really, when you compare it to all the other oil. USO, when you look at where it is relative to where Chevron was, so here it is. And USO is maybe the bad vehicle because you've got a little bit of contango issues, so it's always kind of lagging. But where's oil right now? Where's oil?
52.
Let's not look at USO. Let's look at futures, because I don't like using USO.
Okay, let me bring up. It's been in a trading range. Dennis, don't you listen to the top of the show here?
$50? $50?
52.41, man. This thing's got a lid at 55 and a bottom, not quite at 45. We've been in a 42 and change to 55 trading range for the entire year, and we're just kind of creeping up here. So oil's gone nowhere. Chevron, boy, they are hitting this thing on the lows of the pre-market session at 117 even. I'm looking. Exxon is still staying green here, so that's they had their own report. Let's go.
Exxon's lagged though compared to Chevron.
Yeah, you're right.
Really, when you look at, it's had a good run in the last month or two as well. But when you look at where these stocks were and where they are now, let's just go to the monthlies, and it's always nice to get a longer term perspective. In 2014, ExxonMobil was $100. That's when oil was 90. Now ExxonMobil's $83 with oil at 52. Well, that seems a little bit, but it is ExxonMobil. But now let's look at Chevron. Chevron was 130, and it closed at 118. Oil's down $40, and Chevron's only $10 off the highs. Let's look at ConocoPhillips. ConocoPhillips in 2014 was $80. It's now 51. Let's look at Halliburton. Halliburton in 2014 was $70. It's now 41. Schlumberger, $110. It's now 63. You can see, that the big oil has, and which it should do. The big oil should hold on because they're obviously got a lot more diversification with what they do. Plus, they're just the big oil, so they can take a downturn a lot better than some of these other companies can. But really, when you look at that, Joel, and you put that in perspective, Chevron is just, I feel like it's a little bit too high for maybe where oil is.
All right, we got to take a quick break here to bring in Phil Davis. We'll be right back.
Phil's World.
Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by Benzinga Pro. I'm your co-host, Joel Elkanah, along with Dennis Dick and Spencer Israel. And we have Phil Davis on the line. Phil, how you doing today?
Hi, how's it going?
Going good, man. So let's just talk about the big earnings reports from the big guns.
Yeah, look, you got to hand it to it. I mean, the NASDAQ didn't actually get it wrong. It seemed like a bubble. Everything's going crazy. But Microsoft, Google, Amazon, and Intel are 20% of the NASDAQ's market cap. And those stocks are really all about the Internet of Things and cloud computing, which has been exploding. And we really got a sense of that from their revenue reports yesterday. That just, Amazon wasn't that impressive on the retail side. Google wasn't that impressive on the ad side. Microsoft wasn't impressive on the PC sales with the software side. But they've all shifted their business to aim more towards cloud computing. And Intel, of course, with the chips for the Internet of Things items, it's a complete explosion. I mean, that part of the industry is just going gangbusters.
So, Phil, what did the reports from last night do for your long-term outlook on Amazon, Microsoft, and Google?
Well, I'm sure I'm not going to short them.
Right, that's why I said long-term. Long-term.
Yeah. No, I mean, look, long term, there's a long way to grow in this stuff. We don't even have, like, Sony's about to release their new version of the robot dog. And, the last one was cute. They did it like 5 years ago. I don't know if you remember that little thing that was a cute little robot dog that did basic stuff. The new robot dog runs your house. It's like a robot butler, except it looks like a dog. It connects to all your appliances. It connects to your home security system. It runs your lights. It changes channels on your TV. It's basically like a walking Alexa for you. And
it's a dog. It's cute.
And it's a dog. but Japan's smart because, like, you've probably seen that little Honda robot that's like a really cute little thing, and you can't possibly think it's evil or anything. That's what they're doing. They're sort of like introducing robots to the household in incredibly friendly ways to get people used to the concept, because they're long-range thinkers, and they're like, well, 20 years from now, we're going to sell these people full-size person-looking robots. But they want to get used to the concept of having a robot around, so it's natural. But the point being, though, that's the future, and that future is only just starting. That dog, because that dog, you can't have that dog when it leaves the house die. The kids can't take it outside, and the dog stops working as soon as it loses Wi-Fi. So now you need cellular chips in the dog. You need chips in the car. You need chips in you need chips in your appliances. There's not less chips because people aren't buying PCs. There's double, triple, quadruple as many, and it's all coming online now. This is only just starting. So the future is very, very bright for these companies going down the road. That doesn't mean, though, all of tech has got a bright future, but it certainly means that the guys who are in this space have a lot to look forward to.
So chippers then, AMD, NVIDIA, yes.
Yeah, you can't deny it. I mean, the value's there, the business is there, they're going to keep growing probably. It's a tricky play, though, because a lot of the old tech is dying out, and so you have to kind of balance where the NASDAQ's going. And that's why, by the way, the reason that Google and Microsoft and Amazon and Intel are 20% of the NASDAQ, and meanwhile Apple is another 20% of the NASDAQ. So now you have 5 companies like 40% of the NASDAQ. But the reason is because they're in the space that's growing. That's where tech is going these days. And they've grown much faster than the other NASDAQ companies.
All right, Phil. Are you watching any other reports from this morning? We've had some big oil. We've had healthcare. Merck reporting. What else is on your radar today?
Well, not today, but yesterday and still today, though. I'm pretty sure. Let me check the price. Celgene, we were looking at yesterday. They had that huge drop, and I think they're right about 100. They're done going down. I think this is a fantastic place to start buying them. And we discussed the trade yesterday. By the way, you know the trade I gave you guys last time made 250% in what's it been, a month?
Joel should remember. Joel remembers everything.
I'm pretty good at these things. We did a spread on TZA. Now it's funny because the spread was a hedge on TZA, and we bought 50 of the TZA November 12, 14 bull call spread, and we sold 5 Apple 2021 30 puts, and it netted in at 650. That thing's up to like what is it now? It's 2250 today, so it's up $1,600, which is 246%. So that's even though we didn't need the hedge, but that's because we played it conservatively with very within the money plays. So I want to premise that because I want to say this is what we do when we get into these positions. We did the same thing actually the month before that. We did it with limited brands. So in this case, Celgene, when you get a sell-off like this, it's an opportunity to stake out a position, and you don't have to bet for it to do anything special. You can just bet for it to do something, to come back slightly. So if you want another play that's going to make 250% in a month, do you guys want your people like that, or should we do something else?
No, we like this. Give it to us. Give it to us.
I'm never sure if that's popular, you know.
Well, we like losing 250% in a month.
Yeah, that happens a lot too, right? Here's the thing, though. See, now Celgene fell from. Hang on, I got to look at the chart to make sure I don't screw this up. Celgene came down from, and it was deserved because we knew that they were losing. You know, their painkiller things are in there. They've got drugs on the market that are under, they're losing their patents on a couple of things. So there's reasons for it going down. But it was at $120 for the summer, and even $140. It is now $100. So it's dropped about 40%. Or 30%, I guess. It's dropped about 30%. And we think we're at a good value here. We bought it yesterday. I have to admit this, though. We were already ahead of it. We bought it yesterday when it was hitting 95. But it's at 100 today. It bounced back a little bit, but it's still a great buy. And here's why. Because you can sell the 2020 $80 puts for $9. So if you sell five of those, so you're going to commit to buying 500 shares of Celgene at $80, and you sell 5 of those puts for $9. That's your commitment, and it obligates you to buy it for that price. But $80 is another 20% below where we are now. You will collect $4,500 just for promising to buy it at a 20% discount from here. Then you can pair that with a bull call spread. And if you buy the $80 calls in 2020, and I know that sounds far away, but watch. I'm going to show you next month when I come on again. I will show you how this trade makes a ton of money even though you took a long-term play. You buy the $80 calls for $30. The 2020 $80 calls for $30, you can buy 10 of them. So you buy 10 2020 calls for $30, that's $30,000, and you sell 10 of the 110 calls for $16, and that's $16,000. So your net on the spread, and by the way, if you divide the thing by 5, if you have a smaller account, you just divide it by 5 and do 1 and 2. But it's not that much money, really. It's going to be $14,000 net on the spread, less the $4,500 that you've got on the 5 short puts is $9,500. But this is it's a $30,000 spread that you're doing this on. No, I'm sorry. Wait a minute. Sorry, my mistake. I'm right. It's a $30,000 spread. So if it works out, you'll make 200% on your money. But I'm telling you that all Celgene have to do is slightly recover in the next few months. In fact, it just has to not go down between now and next month, and you'll probably make about 20 or 30% on that spread. And the reason is the volatility of Celgene at the moment is very high. But if it stabilizes, the volatility will go down. We're selling a lot of premium, and that premium will erode.
That's a great point, too. Joel, you were going to ask something?
Yeah. I just want to ask you about gold and silver here. Really falling out of bed. Gold well under 1,300. Silver as well. I know you like to play the precious metals. Any thoughts on gold and silver?
Oh, absolutely. It's a great time to jump in. The reason gold and silver took a dive the last couple of days is the dollar got much stronger. The dollar jumped from where was it the other day? The dollar was down at 93.50. Now it's 94.50. So the dollar topped 1%. And it pushed gold and silver under some technical levels, and they started tumbling fast. So it's a very good opportunity to pick those guys up, especially silver. We really like silver. It's a little bit less volatile. Right now, today, it's at 1667, and gold's at 1266. I like both of those levels. And then you can look to stocks like ABX, Barrick Gold, is on an incredible sale right now. They just had earnings, and the earnings were a little bit disappointing, but they were disappointing because of a one-time tax payment they had to make to Tanzania. And that's not going to repeat itself. So I like them. Now, again, it's the same kind of thing, though. If you want to play Barrick Gold, ABX, the way you can do that is, they just dove from 16 to 1450, so they lost 10%. You can sell the 2020, not 2020, I'm sorry, here it is 2020. The 2020 $15 puts for $2.60. That nets you in for $12.40. That's a really good price on them, and you can leave it at that because that's a really nice return on your money just by itself. In 16 months or 14 months, you're gonna make your $2.50 if it's anywhere above 15. But you can pair that with something like the $15 calls, which are also $2.60, and you don't even have to sell anything against it. That puts you at zero. Your net entry cost will be 15 on Barrick Gold, but you'll make 100% of everything above 15. You don't need to cap your gains. So if they explode back to 20 and you do 10 of those contracts, you'll pick up $5,000 on zero down payment cash. And again, your obligation would be to buy Barrick Gold at 15. But that's a fantastic company at 15.
Phil, I want to take you to one more sector before we let you go here, and it's the department stores. We've got a disastrous report here from JCPenney this morning. They're warning on everything pretty much, saying that they're going to lose 45 cents. They're only supposed to lose, I think, 12 or something. It's down 25% here in the pre-market. It is dragging down all of the other department stores. Macy's is down 6%. Kohl's is down 5%. Nordstrom's trading down over 1% here this morning. Dillard's is offered down and probably going to be trading down here too. What are your thoughts here? Not so much on JCPenney, because I think long term a lot of people think JCPenney is hurting. But what are your thoughts on the other departments?
I can't believe they're still in business.
Well, that's what I've been saying for 5 years. It's the slowest death ever. But is this warranted to knock down all the other department stores for this?
No, of course not. I mean, it's just everybody's panicking because, look, JCPenney's it has been and still is a very poorly run operation. They they made a big effort to change it and turn it around, but it's very difficult to, especially what they tried to do. They tried to attract a new customer base. So you've got a failing store that was in the process of losing its old customer base, and instead of trying to get them back, they said, well, so long, suckers, and they try to appeal to a new customer base, which is crazy because all their competition didn't have the same strategy. Their competition was attempting to maintain their customers, which were the ones JCPenney was trying to attract. So there was no way they were going to win with that strategy. It was insane. And of course it failed, and now they've got nothing. So they're a disaster, but they're a disaster because they played a disastrous thing. You know what it's like? It's like shorting all of baseball because one team loses. And saying, oh, well, all teams are going to lose because this team sucks. That doesn't make any sense. It's a total overreaction. Macy's is a fantastic buy down here. The real estate Macy's holds is phenomenal in value. They've got old stores all over the country that they own 100% of. They've got land. They've got parking lots. As a real estate play by itself, they're a great buy. So Macy's is one I really like. You can play the whole index with Macy's is what, $21 now. You can play the XRT, which is the retail ETF, which is going to take a pounding today. I like XRT too. And they'll probably come in around $40 today. And you can play that one long as well. And again, it's the same kind of thing though. You can sell the options. You guys got time, or you want to have actual plays, or?
Hey, give us a play.
I'll give you a play. All right. Spread the risk. Macy's is, of course, does carry risk in long term. But let's talk about Macy's. Let's do a simple play on Macy's. I would say just sell the 2020 $20 puts. They're $5.
Whoa.
So you get 25% of the stock's price just for promising to buy the stock at today's price. No, not even today's price. Today's price, yeah, they're down to about 20. So you can actually probably get more than 5. In fact, you might even be able to get 5 for the 18 puts. I prefer that one. So let's say, considering the drop that it looks like they're going to have,
Phil? Could you give us the month?
What's that?
He's going out to the 2020.
Oh,
Joel. He says
2020. January 2020.
Got to go out a couple of years
They
to
only
get
are
that kind of
January
premium.
2020. So in January of 2020, I believe you'll be able to sell the $18 puts for $5.
Wow.
That's incredible. That is an incredible thing to do. I would do that, and in fact, since it's so low, there's no harm in buying the $18 calls for about $5 and selling the $25 calls for about $2. So you have a $3 spread, and you have a $5 credit. So you still have a net $2 credit at 18, and you've got the $5 upside spread. So you can end up making $7 on this trade with a $2 credit to start. And your risk is owning Macy's at $18. And that's another one. I bet I'll come back in a month and it'll be a winner.
What do you do, Phil? Just a question, because sometimes these don't work out for whatever reason. Obviously maybe the stock really gets into a disaster, and you've written some puts here, and you own the stock at 18. Is there a scenario where you'll cut out of that trade because maybe I don't want to own the stock at 18, or you'll just take the stock at 18?
No. That's one of the things we teach our members. In fact, that's a big focus of our actual educational portion of what we do at Phil Stock World. Is we teach people how to adjust these trades while they're in progress, so that you can be nimble and move in and out. You can do something called a roll. You can roll the things to a longer contract. First of all, we have to start off with position sizing. So when I'm talking about these trades, usually for us, we'll take an initial entry position, which means we're willing to double down on any of these trades if we don't like the way they're going. But in this case, like with Macy's, here's the thing: if you end up owning them at 18, unless you really think they're going to go bankrupt, you can then sell calls for a few bucks. So you're going to lower your basis even further. So your net is 16 on this trade because you're starting out with a $2 credit. You could then sell the $15 calls for $2 or $3 and drop your basis down to 13. And then you could sell some more puts, like $10 puts for a couple of bucks. And now your net is $11. So either you're going to do that, which is how we double down on a trade, or and the funny thing is you'll end up doubling down. You'll own twice as many at like net 11, but you start out at 16, so that's not bad. Or you can just get out of it. And the funny thing about options in getting out is as they don't move that much. So, it's when it goes up, it's a little disappointing because they don't move as much as the stock would have moved if it goes up a lot. But when it goes down, you may be suffering maybe about 30% of the damage on the way down. And that's huge because that way you can get out of the trade and just move on to something else if you don't like the way it's going. And again, we're fundamentalists, so we're always checking the fundamentals, making sure we still like the story, making sure we still believe in the position.
All right. Phil Davis is with Phil Stock World, is his site. Thanks a lot for joining us today, Phil.
Oh, thanks. Talk to you later. Have a good day.
All right, 8:56. I know, guys, we had discussed on the pre-market show having a quick discussion about some imbalances. Do you want to do that, Dennis?
Oh yeah, so I'll just give you the imbalances here first. Alibaba 155,000 to buy. These are all trends, and the reason why there's a lot of reasons why I give this information in the morning. I'm going to tell you in a second. Square SQ 134,000 to buy. G 157,000 to sell. Those three are there every single day. There's some institution that's just working orders at the open every single day. Sometimes they get offset and sometimes it doesn't show up, but it seems like these institutions are there every day. You can identify institutional order flow. So here's one use of it. When you can identify the institutional order flow at the open, it's so valuable. Why is that? Because there isn't a lot of institutional participation at the open anymore. There used to be years ago, but most of your institutions do everything on the close now. And this is getting to the point because we had a listener saying, why do you give the imbalance information? That information hasn't been useful for 10 years. I will say he has a point. The closing imbalance information has not been useful in 10 years. Why? Because the institutions are on the close. They're too big. You'll see something for 100,000 to buy, and it'll flip to sell at the last second, or it'll pair off. Closing imbalance information on individual stocks and even over the overall market has pretty much been useless for 10 years. But, the odd day on the third Friday of the month, it has some use sometimes. But for the most part, imbalances usually all pair off very close to where the stock is currently trading. That's the closing ones. The open is completely different. And the main reason is because you do not have the institutional participation on the open that you used to have. So when you have one institution that's buying 100,000 shares of something, there is a likelihood that it's not going to pair off at as much of a lower price as it would if it was on the close. I don't know why the institutions that are doing this aren't trading it on the close. It's probably poor execution because they're going to move the price. And their price impact is going to be a lot more on the open. But as traders, we need to identify these opportunities. When you see Alibaba having a buy imbalance every single day, it's not a coincidence that it opens up. Seems like 90% of the time, because that is just a huge order that is moving the price. GE, the sell imbalance has been there forever too. The person that's been doing this is making a lot of money because it opens down every single day. And we can see, the trend in GE just seems to lose 50 cents every day. So they've been selling, maybe they've been liquidating out. We can't, totally know, the reasons behind their selling. Maybe they've just been trying to cut losers, or maybe they've been selling it short. We don't know. All we know is there's a net sell imbalance of 157,000 shares here today in GE, and that typically will move the price down. Now, GE has been trading really thick. It's trading a lot of volume. 157,000 actually is not much for GE. In this market, just because GE is trading so much pre-market volume. But Square 134,000 to buy, absolutely influential on the opening price. So what we're trying to do in giving you this information, we're trying to project the opening for you. We're trying to project where the sources of strength are. When I see buy imbalances across a certain sector, I can confidently say that in all likelihood, that sector is going to open strong. And maybe that strength continues. Maybe it doesn't. But all we know is at the open, that sector is looking strong. That is valuable information to a day trader, and a lot of our listening audience is day traders.
Great point, Dennis. Were there any more besides those three that stuck out to you? Because those are the three we have every day.
We talk about those ones every day because that's been a trend. I like following the trends in these because when you can identify them early, there's money to be made. Yeah, there's all kinds of them here today. So U.S. Steel, X, 90,000 to sell. It's not coincidental. This thing's down 1.2% in the pre-market. General Motors, 47,000 to sell. That's just kind of hanging out here. It's just traded 300 shares, but as of right now, if the stock opened at this point in time, it would open down. Your retailers are all a disaster, which we knew there's going to be a lot of sell imbalance in those. So Macy's 39,000 to sell, Nike 59,000 to sell. Nike's actually been on a pretty impressive 3 or 4 day run here. It looks like it's going to take a little bit of a breather here today. Already trading down $1. It's got 59,000 to sell here off the open, which is going to be a little bit influential on its opening price as well. Your banks are mixed today. So not seeing really, they're all kind of trading, trying to trade a little bit higher, but Goldman's actually trading slightly in the red. So not a lot jumping out for me from the bank imbalances here that are really, showing me anything, of note. Really, that's about, from the big ones here, there's not a ton here today. So today's Twitter 71,000 to sell, and it's, and people look at this for information. When you look, and this data comes out at 8:30 Eastern, the stock prices move on it. So that's how you know this data is important, because price is moving on this data. If price doesn't move on a data point, then the data point is no use. But if price moves on a data point, it's of a lot of use.
All right, great point there, Dennis. And I personally, I've been looking at GE since we've had the imbalances on GE like every day for the past 3 weeks, and I've been looking at that. You can look at the first 5 minutes of trading at 9:30, 9:35, 9:40. It bears fruit in the trading, so that's something to
when these things flip too, Spencer. Sometimes you'll all of a sudden see them flip. You'll see a violent move in the pre-market go the other way. If all of a sudden GE goes to 100,000 to buy or 200,000 to buy, all of a sudden everybody's scrambling because there's traders that are positioning off this in the pre-market, anticipating a lower open. All of a sudden, boom, and it can change just like this. How it changes is, okay, for example, GE 127,000 to sell right now. Fidelity comes in and says, buy 500,000 on the open. All of a sudden, that's going to flip to a 370,000 shares to buy. And every trader's going to be like, whoa, and they're going to be scrambling to cover because we thought it was opening down, and here all of a sudden it might be opening higher. So, and this used to work on the close as well, and that's, I think, what the trader that was listening to the show was saying, 10 years ago. This had a lot of use at the close because it was doing the same thing on the closing prices. But now there's just so much institutional participation on the close that the prices don't move. 100,000 to buy, well, Fidelity's coming in the last second, but 100,000 to sell, and it's going to pair off. So, the institutions know the other institutions are going to be there. That was my friend Carter from BlackRock is the one who originally, said this to me 7 or 8 years ago when I originally was talking with him about imbalances. He says institutions do everything on the close. Nobody knows institutional orders like BlackRock. I mean, you're talking the biggest, money manager in the world. They know how to work orders. And when the guy from BlackRock's telling me they're working everything on the close, or, all the other institutions are working everything on the close, I'm going to listen and you can see it and how it trades out. Those closing, it thickens up and those prints are huge. So yeah, in a little 100,000 share buy imbalance on an individual stock on the close, absolutely useless information. At the open, absolutely useful information because there's no other institutions that are offsetting that, at least at that low of a price. It's typically day traders that are offsetting that, high frequency traders offsetting that, but you don't have that other institution that's lurking out there. And sometimes you do, but for the most part, the institutions are trading on the close.
All right. Great points, Dennis. We'll let everyone go. We'll let you guys go. As far as next week's show, guests include Ivan Feinseth, Peter Chur, and Peter Chur is great, and Murad Askar will be on the show next week as well. He is an oil trader, if memory serves correctly. But that's it for us today. So hope everyone has had a good day so far. You can catch our podcast on iTunes, SoundCloud, and Stitcher, or go to the youtube.com/Benzinga TV. Have a good rest of your day, folks. Have a good weekend as well. We'll be back with you on Monday.